Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. And make sure to check out the VIP Algos link below in the description.
Yeah, definitely check that out. So let's jump right into this. Imagine a company that right now makes absolutely $0 in revenue.
Literally zero.
Zero. They have no final commercial product to sell you today, yet they just locked into a massive, binding, multi-year power agreement with Mark Zuckerberg's Meta.
I mean, it sounds like a punchline to a joke about tech bubbles.
It really does. But today, we are tearing apart the fundamentals, the market sentiment, and, the cutting-edge science behind Oklo.
Right, because our goal here is to figure out if this company is the ultimate visionary play for the AI boom, or if it's just a highly speculative trap.
And the contrast is genuinely staggering when you look at the underlying dynamics here. We are basically watching the digital realm's infinite demand for processing power slam headfirst into the physical realm's hard limits on energy generation.
Yeah, the grid is maxed out.
Exactly. And Oklo is positioning itself directly at the epicenter of that collision.
And that is exactly the paradox I want you, the listener, to keep in mind as we start our talk today. How does a pre-revenue startup convince hyperscalers like some of those data-driven, risk-averse corporations on the planet to sign binding agreements?
It's a huge question.
Right. So we can't really evaluate the wealth-building context without understanding what they are actually promising to build. So let's start with the technology. They call it the Aurora Powerhouse.
Yeah, the Aurora Powerhouse.
What makes this so radically different from, the giant steaming concrete cooling towers we usually associate with nuclear power?
Well, you have to completely strip away the image of traditional light wire reactors. Those legacy systems require massive geographical footprints.
Huge facilities.
Right, and constant refueling cycles, plus incredibly complex water cooling infrastructure. The Aurora Powerhouse operates on an entirely different physical premise, which is fast fission technology.
Okay, fast fission.
Yeah. Instead of traditional fuel rods sitting in giant pools of water, it utilizes metallic uranium fuel pellets. But the critical mechanism here, the true differentiator driving these tech partnerships, is their closed-loop recycling system.
Okay, let me stop you right there, because closed loop is, well, it's a buzzword that gets thrown around a lot in Silicon Valley.
Oh, absolutely.
What is the actual physical mechanism? Like, how does a nuclear reactor recycle its own fuel?
It really comes down to neutron energy. Traditional light water reactors use only a tiny fraction of the potential energy in their uranium fuel before the reaction slows down.
And then the rod is just what officially classified as waste?
Exactly. It just becomes waste. Fast fission reactors, however, operate at much higher neutron energies. This environment allows the reactor to actually fission or split the heavier isotopes that normally just build up as useless waste in a conventional system.
Oh, wow. So it's basically eating its own waste.
That's a good way to put it. The system is continuously breaking down its own radioactive byproducts to keep the reaction going. Functionally, this means an Aurora Powerhouse can operate for a full decade without needing to be shut down and refueled.
10 years.
A full decade, yeah.
So instead of managing this hypersensitive, highly regulated supply chain of radioactive material every 18 months, it's essentially a massive 10-year rechargeable battery for AI data centers.
That is exactly the mechanism. Now, connect that capability to a company like Meta or Switch.
Right.
They are building hyperscale AI data centers that literally cannot be turned off. I mean, a power disruption of even a few seconds can corrupt massive training models.
Which costs them millions.
Exactly. And wind and solar are fantastic for meeting corporate carbon goals, but they're fundamentally intermittent. I mean, the sun sets, the wind dies down.
Yeah, data centers require uninterrupted baseload power.
Right. So if Oklo can deliver a 10-year continuous, clean nuclear battery, they are solving the hyperscaler's most existential threat.
Which brings immediate logic to this massive commercial pipeline we're seeing. Oklo has secured over 14 gigawatts of power demand under non-binding letters of intent.
That's a massive number.
It is. But the real weight, like the actual jaw droppers, are the partnerships. You have that binding 1.2 gigawatt agreement with Meta and a massive 12 gigawatt partnership with Switch.
Yeah, the Switch deal is huge.
It seems to me that locking in that early hyperscaler demand isn't just about guaranteeing future revenue. It's a massive barrier to entry. I mean, they are forcing competitors to play catch-up while validating the tech to federal regulators.
Precisely. By securing companies like Meta and Switch, it entirely shifts the narrative. It takes Oklo from being, a theoretical science experiment to a critical infrastructure project backed by trillion-dollar entities.
Which is huge for optics.
It is. That kind of validation is incredibly powerful when sitting across the table from regulatory bodies.
But here's where the rubber meets the road. If they're building a decade-long nuclear battery, the upfront capital expenditure must be just astronomical.
Oh, it's massive.
Someone has to foot the bill to pour the concrete, secure the uranium, and build these physical structures while they wait for Meta's checks to actually clear in 2027.
Let's dig into Oklo's fundamentals and the balance sheet because the pre-revenue reality here is pretty stark.
It is, and we really need to be unflinching about those numbers. In fiscal year 2024, Oklo reported a net loss of roughly $74 million.
Ouch.
Yeah, with a forward earnings per share sitting at negative 88 cents. So they are burning cash aggressively. But when I look at the financial breakdowns, that loss isn't from operational bloat or like lavish executive retreats, right?
Oh, not all.
It's almost entirely R&D and the heavy build-out costs required to deploy those first powerhouses?
Correct. You do not prototype advanced nuclear reactors on a shoestring budget. Expanding net losses here reflect the physical reality of building next-generation infrastructure.
Right.
But what sets Oklo apart from 100 other ambitious startups is their liquidity profile. They are sitting on a truly massive war chest.
Let's talk about that war chest.
At the end of the recent quarter, they held nearly $1.6 billion in cash and cash equivalents, plus over $600 million in marketable debt securities.
So you add that up, and you're looking at roughly $2.5 billion in total liquidity. And what you, the listener, need to know is that this specific number is the key to their survival.
Absolutely.
It provides them with the actual financial runway to reach that late 2027 commercialization target without needing distress financing.
That is the ultimate differentiator. I mean, in capital-intensive industries, visionary companies often go bankrupt, not because their technology failed.
Right, but because they just ran out of money 2 years before the product was ready.
Exactly. Oklo's $2.5 billion essentially buys them the time to execute. They have the cash to survive the build-out phase without heavily diluting their current shareholders in the near term.
Okay, but I have to push back a little on the analyst projections moving forward. The models are forecasting revenue to jump from about $4.5 million in 2027, when they supposedly turn the lights on, to over $51 million by 2028.
Right.
And some are projecting positive earnings by 2029. How can anyone accurately model explosive growth like that for a company that effectively makes $0 today? I mean, it feels like analysts are just pulling numbers out of thin air to justify the valuation.
Well, you have to view those projections not as guaranteed forecasts, but as highly conditional binary models.
What do you mean by binary?
They are mathematical representations of a perfect execution timeline. If that first Aurora powerhouse goes critical in late 2027 and the baseload power starts flowing to a hyperscaler, the revenue model flips literally overnight.
Oh, I see.
Yeah, the analysts aren't predicting magical organic sales growth month over month. They are simply mapping the sheer scale of the power contracts that are already signed.
Assuming the switch successfully gets flipped.
Exactly, if the switch gets flipped.
So everything comes down to hitting that 2027 target, which means with the financial runway secured, the market isn't trading Oklo based on quarterly sales. It's trading entirely on regulatory catalysts and the behavior of its insiders.
Yeah, it's a headline-driven market for them.
Let's talk about the sentiment, because the market is treating every single headline like a life or death event.
It is a purely binary trading environment right now. Let's look at the institutional progress. In June 2026, a massive catalyst hit when the Department of Energy approved Oklo's preliminary documented safety analysis at the Idaho National Lab.
Which sounds incredibly dense. What does that actually mean for the timeline? Like, a safety analysis at a national lab sounds great for a press release, but how does it move the needle toward actual commercialization?
It is monumental because the DOE is formally validating the core safety case of the fast fission design on federal property.
Okay.
It's the foundational proof of concept that allows Oklo to confidently push forward with actual site preparations and physical deployment plans.
So it's a huge green light.
Exactly. And following that approval, they signed a memorandum of understanding with Standard Nuclear to explore fuel recycling and the utilization of surplus plutonium.
Wait, let me stop you there. Surplus plutonium.
Yeah.
Like from old nuclear weapons. How does a startup get clearance to handle Cold War-era nuclear material.
That is the inherent beauty of the fast fission design we discussed earlier. Because it operates at higher neutron energies and can utilize heavier isotopes, it can actually consume legacy nuclear waste and surplus weapons material as fuel.
What?
It is. One analyst aptly titled a piece on this, "From Cold War liability to advanced nuclear fuel." They are literally taking a geopolitical hazard and turning it into a commercial asset.
Wow. Combine that with their recent acquisition of ARAM, and you start to see a very deliberate strategy of vertical integration here.
Let's expand on the Aramec deal because it seems crucial.
Yeah, by buying Aramec, they aren't just getting new technology, they're acquiring their own supply chain. In an industry notorious for bottlenecks, owning the company that manufactures your specialized parts means you aren't waiting in line behind 10 other companies for a crucial valve.
Exactly. They are systematically removing external points of failure. Between the DOE approvals, the fuel recycling initiatives, and vertically integrating their supply chain, the fundamental path forward is being actively de-risked.
And yet, the analyst community remains deeply fractured on how to price this progress.
Oh, totally split.
You have Goldman Sachs looking at the DOE plutonium announcements and raising their target to $66, while UBS maintained a neutral rating and actually dropped theirs to $55.
Even though the broader consensus is still quite high, generally hovering between the $85 to $97 range.
Right. But here is the contradiction that really highlights the emotional, erratic state of retail sentiment right now. In early June, Oklo's stock dropped 12% practically overnight.
Yeah, that was brutal.
And the catalyst wasn't a failed regulatory test or a lost contract. It was the disclosure that Oklo's co-founders had sold over $13 million in shares.
Right.
If the fundamentals are actively de-risking, why did this cause such a massive panic?
Because retail investors frequently react to headlines without reading the fine print of SEC filings. When you see a notification that founders are dumping stock, the visceral assumption is that the insiders know a catastrophic delay is coming, so they are cashing out while they still can.
Right, the classic assumption is that the insiders are abandoning ship. Do you actually dig into the mechanics of the filings? Treating this like a crisis is like a fire alarm going off in a crowded theater and people trampling each other to get out.
Completely ignoring the fact that it was a scheduled fire drill.
It's exactly a scheduled fire drill.
That is a perfect way to frame it. These specific sales were executed under prearranged 10b5-1 plans.
Which are what exactly?
These are automated, legally binding trading schedules that executives set up months, sometimes even years in advance. They're designed specifically to prevent any accusations of insider trading by locking in the sale date and the volume, regardless of what the stock price or the company's internal news is doing at that specific moment.
So this $13 million sale was put on a calendar long before the recent DOE regulatory wins even happened.
Precisely. It was just a routine diversification of personal assets, not a signal of internal doom. But the market, in its hyper-reactive state, sold first and asked questions later.
And that specific tug-of-war strong institutional progress colliding with retail panic has created a fascinating, incredibly tense technical setup on the charts.
Let's look at the price action.
Yeah. Oklo is currently down roughly 54% from its all-time peak, hovering right around $60 a share. It's trading just below its 20-day and 50-day moving averages, which sit around $62.70 and $64.40 respectively.
It is textbook base building consolidation. After the broader macroeconomic pressures and the insider selling panic subsided, the stock found a floor. And if we look at momentum, the relative strength index, the RSI, is sitting perfectly flat at around 48.
So the market is completely paralyzed. With an RSI sitting flat at 48, it means the stock is neither overbought by euphoric buyers nor oversold by panic sellers. It's just waiting for a catalyst to force a direction.
Exactly.
But the metric that really adds tension here is the short interest. We saw short interest drop materially from over 35 million shares down to around 27 million.
That's a huge drop.
It is. That's still about 18% of the total float,
Yeah.
but the bears are clearly covering their positions. If you have neutral momentum and short sellers actively stepping back, it sets up an intense environment for the upcoming August 10th earnings, doesn't it?
Absolutely. When a stock has an 18% short float and is consolidating tightly, any surprise positive news, perhaps an unexpectedly strong update on the DOE pilot program, forces those remaining short sellers to buy shares rapidly to cover their bets.
Which drives the price up even faster.
Right. That sudden influx of forced buying pressure acts as an accelerant. It creates a coiled spring effect.
It forces a squeeze. The price shoots up because shorts are scrambling for the exits, But obviously, a coiled spring can snap in either direction.
Very true.
If the August 10th update is bad, the bottom drops out just as violently, which means we have to rigorously examine the bear case. What are the severe risks that could fundamentally break Oklo's 2027 timeline?
Well, the execution risk is the only thing that matters. We have to reiterate that buying Oklo today means you are paying a massive premium for a reality that does not exist yet. You are buying the 2027 promise.
Okay, so NRC licensing, the Nuclear Regulatory Commission, is
Yeah.
the obvious nightmare. I get that federal bureaucracy is notoriously slow, but why is it specifically harder for Oklo to get approved compared to existing plants?
Because the entire framework of the Nuclear Regulatory Commission is built around traditional water-cooled reactors. That is their historical paradigm.
Ah, so they don't really have a playbook for this.
Exactly. Oklo is bringing a fast-fission metallic fuel system to the table. The NRC has to essentially evaluate an entirely different physical process.
Right.
If they demand more operational data or require additional safety redundancies simply because they are unfamiliar with the operational dynamics of fast fission at scale, a standard 6-month evaluation could easily snowball into a 3-year delay.
That is a massive bottleneck. But even if the government stamps the paperwork tomorrow, I've read they don't even have the actual fuel to put in the reactors.
Yeah.
What is the bottleneck with OKU?
Oh, OKU, yes. OKU, which stands for High Assay Low Enriched Uranium, is the specific, specialized lifeblood of these advanced reactors.
Okay.
Unlike traditional reactor fuel, OKU is enriched to between 5 and 20%. The fundamental problem is that the domestic supply chain for AQU is severely constrained. Historically, Russia was the primary commercial supplier globally.
Oh, wow. Which is obviously a huge geopolitical issue right now.
Completely. Building out a robust, secure domestic pipeline takes massive investment and a lot of time. If Oklo finishes constructing the powerhouse but cannot secure a steady supply of HALEU, they essentially have a $2 billion paperweight.
And historically, the nuclear energy sector is famous for these exact kinds of delays. Severe cost overruns and missed deadlines are practically the industry standard.
Yeah, unfortunately.
So let's run the ultimate bear case scenario.
Yeah.
If commercialization slips from 2027 to 2029 or 2030, does the entire investment thesis just fall apart?
It changes the math violently because of dilution risk. Remember that $2.5 billion war chest?
Yeah, the one way.
That covers the aggressive cash burn rate to 2027. If commercialization slips to 2030, the cash burn continues unabated, but the incoming revenue stays at zero.
So the runway just ends. They run out of money before they can even turn the lights on.
Exactly. And a pre-revenue company that runs out of cash has to raise additional equity.
Which means selling more shares.
Right. If Oklo goes to the public market to raise funds after announcing a 3-year delay, they are negotiating from a position of profound weakness. They would likely have to issue massive amounts of new shares at a steep discount, heavily diluting the investors who bought in today.
So the technology might eventually work flawlessly, but the early investors would see the value of their holdings completely crushed.
Exactly. It's a huge risk.
So it's the ultimate high-stakes bet. You have the unprecedented upside of literally fueling the artificial intelligence revolution, balanced against the brutal, unforgiving realities of nuclear regulation and capital burn.
Right.
Where do analysts land when weighing all these factors together for the final verdict?
Taking all the data into account, the massive $2.5 billion liquidity profile, the tangible regulatory progress of the DOE, and the sheer scale of the hyperscaler demand, the final analysis issues an 8 out of 10 bullish score.
An 8 out of 10. I mean, that is a remarkably high conviction rating considering the execution risk we just talked about.
It is. But the crucial caveat here is that Oklo is positioned strictly as a multi-year investment horizon. Analysts view this as a long-term strategy, not a short-term swing trade.
Right, you're not flipping this next week.
Exactly. The analysts see the fortified balance sheet and strategic acquisitions like ARMEC as clear evidence that Oklo is actively and successfully de-risking its path to that late 2027 milestone. It represents one of the very few pure-play opportunities to gain early, meaningful exposure to the advanced nuclear renaissance.
You're essentially betting that their financial war chest is deep enough to build the bridge across the canyon of federal regulation, straight into the promised land of infinite AI power demand.
That's the bet.
So, as we wrap up our breakdown today, I want to leave you with a final thought to ponder on your own, a thread to pull at. We spent a lot of time dissecting Oklo's technology and their internal financials, but think about the other side of that equation. Think about Meta.
Yeah, that's a great point.
Tech giants are famously risk-averse when it comes to their infrastructure. They obsess over efficiency, redundancy, and guaranteed deliverables. So if a company as methodical as Meta is willing to bypass traditional power grids and lock into a binding 1.2 gigawatt agreement for a completely unproven next-generation nuclear reactor that isn't even fully built yet.
It really makes you wonder.
What does that tell you?
It is the multi-trillion-dollar question.
Exactly. What do Meta's internal, highly secretive diagnostic models say about exactly how much power artificial intelligence is actually going to consume in the next decade? Are we overestimating Oklo's technological promise, or are we fundamentally underestimating the sheer, unyielding desperation these tech giants have for clean baseload power?
It's definitely something to think about.
Sometimes the most telling metric isn't found on the balance sheet of the startup, but in the desperate lengths the smartest companies in the world will go to acquire their product. Think about that.
Absolutely.
All right, that brings us to the end. Just a reminder, our bullish score sits at an 8 out of 10 with a multi-year long-term view. If you found this useful, please remember to subscribe, like, and comment, and be sure to check out the VIP Algos link below in the description. See you next time.